This one here is going to be a continuation of the last video where, as you can see here, all of the transactions, all 8 transactions were analyzed in the accounting equation. So here's the big picture here. So if I zoom out or zoom in, we can see what actually happened per transaction. So I've scrolled over to the right to get the full picture for what occurred in, transaction number 1. But if we want to see it from a holistic view, we just zoom out here, make sure that we can actually have every single transactions in one screen, and this is the result of all 8 transactions. So the next thing we're going to do is figure out how we're going to communicate these economic activities to people that are interested in knowing how the company is doing. So when it comes to communication, there are 4 prevalent type of financial statements that can be used in order to communicate these transactions that we see here that are reported in the accounting equation. So just scrolling down here, and we're going to put in financial statements. All right, so like I said, there's 4, I want to say, common or prevalent financial statements that companies use. One of them is the income statement. Okay, the income statement is also known as the P&L. All right, they say P&L or P&L. Usually, just from my experience with organizations, working in organizations, they say P&L a lot to refer to the income statement. I rarely heard the actual name income statement anywhere that I worked at. So it was always known as the P&L. What does the P&L look like? How does the P&L look? What's the bottom line on the P&L, et cetera, et cetera. Okay, so income statement, P&L. P&L stands for profit and loss. And within this statement, the type of accounts that are shown in this statement are your revenue accounts and your expense accounts. Okay, so the income statement pretty much just displays a company's performance in a given period. So if it's the period of January, the income statement is going to show the revenues and expenses that were generated for a particular month. In this case, the month of January. So it only focuses on the period of time, how the company's doing. So again, the income statement it displays the company's financial performance. How did they perform with the utilization of their resources? The next financial statement here is the statement of owner's equity. Now, the statement of owner's equity is pretty much like the statement of retained earnings. Statement of retained earnings, that statement or financial statement is used by big organizations that have a multitude of investors that are owning and controlling that business. Now, in this case, I'm using statement of owner's equity because we're focused on one owner, one person that owns a whole business. So the statement of owner's equity, it does show the beginning capital balance. I'll go ahead and put this on here. Beginning capital balance is the capital balance that is carried over from the previous period. So beginning capital balance. Let me just draw a little arrow over here and put on here capital balance. Plus any contributions that the owner made. Okay, so this will be owner contributions. So this is if the owner decides to put in cash, put in equipment, contribute inventory. These are all also classified as owner contributions. So this does increase the equity. Then we also going to add net income. Okay, net income comes from the P&L, the income statement here. And the way how to, oh, I just realized I spelled income wrong. I just left out the C. So the way to get the net income or figure out how to come up with the net income is you'll take your revenues and subtract out your expenses, which is shown on the income statement, to get your net income. So the result of a net income comes from when revenues is greater than expenses. If it's the other way around, where expenses are greater than revenues, then it is not a net income. Instead, it is a net loss. Okay. All right. So back to the statement of owner's equity. So this net income is what actually gets carried over to the statement of owner's equity, because it's pretty much the bottom line, how the business performed. And then we're going to subtract out owner's withdrawals. So if the owner decides to go in and take out money or anything else that's going to affect equity, we're going to subtract it from this capital balance. And then this is where we get our ending capital balance. Okay, and all of these components here are shown in the statement of owner's equity. Then after that, we have the balance sheet. Okay, the balance sheet is pretty much a reflection of the accounting equation, meaning that the balance sheet consists of 3 sections, which are assets, liabilities, and equity. Okay, so pretty same as the accounting equation as far as what it displays. So the balance sheet also has assets, liabilities, and equity. Now, what the balance sheet displays is the company's current financial position, or the company's current financial health. It gives you a snapshot of what the company has in resources, what the company owes, and then what is the equity, pretty much based on the assets and the liabilities. So balance sheet accounts, so assets are your resources, liabilities, and equity are your funding sources. So in another video, I'm going to actually display different or various types of accounts that are classified as assets, liabilities, and also equity, revenue, and expenses. Okay, so again, the balance sheet shows your assets, liabilities, and equity. And we know that assets must equal liabilities plus equity combined based on the accounting equation. Then the last one, we have statement of cash flows. So the statement of cash flows shows a company's cash inflows and outflows. Okay, and it shows the cash inflows and outflows in 3 different sections. Okay, the first section is going to be the operating activity section. Okay, this is a section where it shows all the cash that went in and out of the business based on the business normal operations. Pretty much, what is it that the business absolutely need in order to operate the business? So all of those activities are going to be lumped into the operating activity section. Then we have the investing activity section. Investing activity is when when a company is, I want to say, acquire something long term. It's physical too. So this is where a company could, invest, for example, in an equipment. So they purchase an equipment, and so that equipment is now an investment. So if you purchased it with cash partial cash, whatever the case may be, this will end up being in the investing activity section. So you're investing in a long-term, tangible or physical asset. Then we have the last section here, which is the financing activity section. And this is the last section, which is, it shows the funds that you use into the business. Okay, so for example, as the owner, if you contribute cash into the business, you're funding or financing your business with that cash. So you funding it. Okay, so let me see another example. If you took out a loan, to fund the business, all right, that's going to be underneath the financing activity section, because when you take out that loan, you're receiving cash for you taking out a loan. So that cash will go into the statement of cash flows underneath financing activity. And if the owner decides to withdraw money, withdraw cash, it has to be cash, that's also going to fall underneath the financing activity section. The owner's affecting the business adversely just from taking the cash out of the business. So that cash is funding the business. So when you take it out, it's going to decrease the cash amount. But yes, it does go in the financing activity section. So in the next video, what I want to do is actually, because I know this video is kind of long, I want to actually prepare all 4 financial statements given the 8 transactions that were analyzed in the accounting equation for Bob Consulting Company.